October's market was unprecedented in recent history. Since 2009 almost, we've not seen stock markets retreat quite as heavily as they did in October for a very long time. And it scared investors. The S&P, which is the US index, was down quite heavily. Markets in general were down nearly 10%. With the momentum that you're seeing in the market at the moment, when you have a couple of down days, that exacerbates the sell-off and people just start selling and selling and selling. You factor in computers around that as well, and they're hitting the sell button even more. So the downturn was that much sharper, which meant that the volatility was that much higher. We have to take into account that volatility, that sea change towards a more volatile environment is something that we need to make sure that governs how we invest going forwards. Defense is going to be key. The last 10 years have all been about making money for clients. Now it's about defending clients. Now it's about not giving back the capital that we've generated in the last 10 years. And to do that, you need to shift the portfolios into a much more defensive stance if you have a hope of outperforming this market. Thinking like a trader and making sure that you're capitalizing on the value that you see in the markets. So October, whilst it was a volatile period, threw up a lot of opportunities across the market. So making sure that we are putting those in and capitalizing on those for our investors is also going to be key. Some of the themes that we're going to be seeing in 2019 are definitely defensive themes. Definitely themes that are currently oversold, such as emerging market debt, emerging markets, gold, government treasuries. All of these things are going to be very important as we move into the next 2 years. But it's definitely what led us in the last 10 years isn't going to be what leads us in the next 2. So we have to make sure that the portfolios are ready for that. Brexit is a hot potato, and what it means for UK investors is a topic that seems to be occupying every single headline. And for us as investors, we've got to think about it in a few ways. You've got to think about what the most likely outcome is, and you've got to think about how you're going to invest in that. It is a binary outcome. Are we going to get a deal? Are we not going to get a deal? And at the moment, it seems to be so uncertain. Now we have to make sure that the portfolios are ready for either outcome, because investing for one is not a responsible allocation of capital. We need to make sure that we are invested for both. So I think ultimately we will get a deal at Brexit. I think cooler heads will prevail. We need Europe and Europe needs us. I think the hot potato for Theresa May is going to be within her own cabinet, not within Brussels. But I do think that we will be able to get a deal. And I do think you're going to see a higher pound. I do think you're going to see domestic stocks starting to do a little bit better. But this is not a period that we need to panic. This is not a period where we need to think this is the end of all things and we need to start selling all of our equity positions. That's not where we are. We're going to keep investing. We're going to keep taking value in the market. And we're going to keep taking profits for our clients whilst building the defensive moats in the portfolios to ensure that when we do hit that period of sustained volatility, where we hit potentially a recession, a market crash, the portfolios are perfectly positioned for that, and they're owning the assets that will outperform in that environment. This is an opportunity, and we need to make sure that we're invested correctly for it.